Hello, good morning, everyone. We will wait a little bit to ensure that everyone that has registered has joined. So we will begin very shortly, but thank you all for joining. Okay, well, I think we can get started. Thank you all again for joining us for today's webinar on corporate income tax in St. Kitts and Nevis. For those of you that I have not had the pleasure of meeting personally, my name is Karina Sanin and I am OMC's Commercial Vice President. I will be stepping in today for Sandra, who unfortunately could not join us today, and I have very, very big shoes to fill, but I will do my best to give you a good overview of the Nevis tax regime and some of the changes that the jurisdiction has had this year. I'll also try to answer some of your questions. We've received many, many questions in the past few weeks, so I will try to answer some of those. And in case that there are questions that I cannot answer, I'll be happy to answer those after the webinar is over. So let's review the agenda for the day. First, we will review the St. Kitts and Nevis Income Tax Act, which outlines the legal framework for taxes in St. Kitts and Nevis. We will then review a chronology of the inclusion and the exclusion of St. Kitts and Nevis to and from the list of non-cooperative jurisdictions in tax matters by the European Union. And this is very important because this is in part what's driving all of these changes. After this, we will review the different amendments to the corporate laws, including the St. Kitts and Nevis Companies Act, the Nevis Business Corporations Ordinance of 2017, and the Nevis Limited Liability Companies Ordinance of 2017. I will then walk you through the new CIT 101 tax return form, which all companies formed under the above legislations will need to fill now by December 31st, 2020. This has changed quite a bit in the past few weeks, but now the deadline has been extended to December 31st, 2020. And I will also share with you the guidance on tax residence and taxable presence in the Federation. This is very important because this will help you fill the CIT forms. Lastly, we'll have some time for Q&A, and we will do our very best to answer some of your questions with the information that has been shared with us in the past few days. Again, this information has changed in the past few weeks, so we will share with you what we know up to date. So let's get started and let's talk a little bit about St. Kitts and Nevis and its tax regime. And I think it's important to clarify that although St. Kitts and Nevis are two different islands, they are really one country, the Federation of St. Kitts and Nevis. So you'll hear me refer to the Federation. The Federation includes both St. Kitts and Nevis. And it has been an independent country since 1983. It is part of the Commonwealth, recognizing Queen Elizabeth II as the Queen and as the head of state. And the Income Tax Act was drafted in 1966. It covers the entire Federation of St. Kitts and Nevis, and it was enacted in 1967. It has gone through many amendments. The most recent one, and the one that we will be focusing on today, was in 2017. After this, about 2 years ago, so around 2019, we began hearing that a new amendment was being worked on. And we actually believe that this amendment will be finalized by the end of this year. This has not been a regular year by any means. So we're hoping that it will be finalized by the end of the year, and we'll keep you informed of any new developments. But for now, we'll focus on what we do know. It's very important to note that Nevis does have a corporate income tax for companies incorporated in the Federation, and it's a 33% of the global income. And we'll cover later on throughout the presentation what this means and what are the different factors that we need to consider to determine whether the tax is applicable or not, because it will not apply in all cases. So let us review some of the international pressures on St. Kitts and Nevis. And I mentioned this very briefly earlier. This is in part what's driving all the changes that we're seeing today in the Federation. So the first ever official EU list of non-cooperative tax jurisdictions was agreed by member states on December 5th, 2017. So we're going to talk about what happened onward. This list is part of the European Union's work to fight tax evasion and avoidance. And of course, it aims to create a stronger deterrent for countries that are not considered to be playing fairly on tax matters. So it's important to note that. So on March 13th of 2018, about a year after the first official list came out, the EU includes St. Kitts and Nevis on the list of non-cooperative jurisdictions on tax matters. It puts it on the blacklist. And this was due in part, not entirely, but in part to the tax exemptions that were placed at the time for companies incorporated in St. Kitts and Nevis. A few months after the implementation of the first amendment to the tax regime on May 25th, 2018, so a few months after, the EU removes St. Kitts and Nevis from the list of non-cooperative jurisdictions on tax matters. And this was based on their commitment to comply with EU recommendations. It was placed on the gray list, which is reserved for countries that are not necessarily meeting the standards, but that are very committed to improving their transparency standards. So after this, on February 18th, 2020, the EU removed St. Kitts and Nevis from the list entirely based on its ability to implement, even before the agreed date, all the necessary reforms to comply with the principles of good tax practice. And this is why we've seen so many changes in a very short period of time, and why these changes may seem a little rash. So let's take a look now at the Companies Act, which applies to St. Kitts companies. And we do not have many of these anymore, but for the purposes of this webinar, we'll focus on section 224. So in 2017, a company that carried out business exclusively with non-residents was exempt from all taxes on income, capital gains, and withholding taxes at source. An amendment was then made in 2018, and all companies incorporated under this legislation would cease to operate on June 20th, 2021. So this means that after this amendment, no tax-exempt companies can be incorporated, and all tax-exempt companies will cease to operate by June 20th, 2021. And there are a lot of dates here, so please bear with me. I'll be happy to clarify things later on, but there are many dates to keep in mind, and I'll try to keep them clear throughout the presentation. So after this, in 2019, a new amendment was made by which companies incorporated under this legislation could not acquire new assets or participate in any activity that was inconsistent with the purpose for which the company was incorporated. Also, companies could no longer acquire intellectual property assets, and we'll discuss later on why this is so important. There is a lot of focus on intellectual property assets, so this is something that's important to keep in mind throughout the webinar. Okay, so let me walk you through the amendments to the Nevis Business Corporations Ordinance, the NBCs, and we'll talk specifically about section 136. So in 2017, the company, if it was not conducting business in St. Kitts and Nevis, it was not subject to any corporate tax. income tax, withholding tax, stamp taxes, asset tax, exchange controls, or any other taxes. In other words, it was absolutely exempt from all taxes. And this was the key issue for the OECD. With a 2018 amendment, a grandfathered period is granted until June 30th, 2021 to companies that were incorporated prior to January 1st, 2019. Again, a lot of dates, so bear with me. All companies incorporated before January 1st, 2019 would still be tax exempt until June 30th of next year, so 2021. And all companies incorporated after January 1st, 2019 would now be subject to taxes. So this was a key change in the jurisdiction. In 2019, they made another amendment with further restrictions. The new amendment made it so the grandfather period would not be applicable to companies that acquired assets in 2019, or those that participated in any new commercial activities that could give rise to taxable income. If the company had not acquired any assets or was performing any new activity that could give rise to taxable income, they would still benefit from the grandfather or the grace period. The same holds true for Nevis limited liability companies, or LLCs. So let's take a look at the changes to Section 96 since 2017. So in 2017, similar to the NBC's changes, Section 96 stated that if the company was not conducting business in St. Kitts and Nevis, it would not be subject to corporate taxes, income taxes, withholding taxes, or any other type of taxes. In 2018, this is restricted and a grandfather period is approved until June 30th, 2021, but only to companies incorporated before January 1st of 2019. Then in 2019, again, the grace period or grandfather period is eliminated for companies that acquired assets in 2019 and or those who participated in new commercial activities that generate taxable income. You will note that the changes again are very similar to the NBCs in terms of further restrictions and the tax treatment in general. So let's fast forward now to August 2020, when we were first introduced to the CIT 101 tax return form. It's important to frame this and let's try to answer why we're being asked to complete these forms. You know, what is behind all of this? I think this is something that's important for us to understand. And, you know, in short, the main objective is to meet the requirements of the OECD BEPS, so base erosion and profit shifting action 5. And this outlines the minimum standards to avoid harmful tax practices. Secondly, it aims to monitor data on grandfathered non-IP regimes and enhance transparency requirements for IP regimes. As I mentioned earlier, there's a lot of focus on IP assets. And lastly, it paves the way for spontaneous exchange of information under the common reporting standards. And this applies only for IP assets or IP activity. So that's important to note again, the focus on IP assets and IP activity. So let's go over the basics. Who should fill out this form and report? In essence, all companies in the registry as of December 31st, 2019 need to report. What period should be reported? January to December of 2019, because this is the way it was determined by the Inland Revenue Department. So even if a company only had activities within a small period of time, so say a few 2 or 3 months, it still needs to report for the period of January to December of 2019. What is the deadline? This is another important question. The deadline is December 31st, 2020. So a few months from now, and this deadline has been extended. The first deadline that we had was August 31st. This was then extended to October 31st. And given conversations that all of the registered agents in St. Kitts and Nevis have had with the in the revenue department, the controller, and everyone involved in the decision-making within the Federation. We've been able to extend that to December 31st, 2020. Are there any penalties for non-compliance? Yes, there are penalties up to 10,000 Eastern Caribbean dollars, which is the equivalent of approximately 3,700 US dollars. So having said that, let's move into the actual form. As you can see in this form, general information about the entity is requested. This includes company name, registration number, the business activity, the head office, and we'll talk a little bit more about what the head office implies. The St. Kitts and Nevis address, the contact information, the company representative information. All of this is important information that you'll have to fill out in the form. And there are some key points to remember. First, as I mentioned before, the reporting period is from January 1st, 2019 to December 31st, 2019. As I explained before, this is regardless of whether the company had activities for 1 month or 12 months. You will note that there are several contacts to be filled out in this section. And I'll briefly describe some of these contacts. But let's start with the address of the head office. This is not the registered agent's address. This is a common misconception. The head office address is where the company is said to be carrying out its activities. And this is very important. We'll see later why. The St. Kitts and Nevis address is the registered agent's address. So the head office and the St. Kitts and Nevis address are two different things. And this is a question that has been asked over and over since the form was first introduced to us. So it's very important to note that the head address is where the company is said to be carrying out activities, and the St. Kitts and Nevis address is indeed the registered agent's address. Now let's go into the different contacts that we have. We have the contact information, which is the contact information of the person that is completing the form. So this could be the director, the shareholder, the introducer, or any other related party. And then we have the company representative information. And this should be our corporate supervisor and registered office. So if you do not have that information, we're happy to provide it for you. It should be pre-filled in the forms that you received, but we know that given different versions of software, this may not show when you actually open up the form. So if you do not have this address, we're happy to provide that information for you. The contact representative information should be that of our corporate supervisor, Ms. Caroline Berry, and again, happy to provide that information if you don't have it. It's also important to note that Nevis entities can now register and submit their own CIT 101 forms directly through the newly added Registered Entities tab in the portal. This is something that's different from when we first got the forms in August. So this hopefully is good news for those of you that want to do this directly. If you still want us to do this for you, we will gladly provide you with this service. It's not a problem at all, but you now have the ability to do it directly in the portal. Okay, so let's move into the second page of this form, which is where we get into the actual declaration and the appropriate schedules. And there are basically 4 questions. And what I'll do today is I'll try to explain the reasoning behind each question, hoping that this will provide guidance on how to actually complete the questionnaire. The first question aims to determine whether the company is still benefiting from the grace period, which, as I mentioned before, is until June 30th of 2021. Section 2, or question 2, is aimed at determining which companies have acquired intellectual property assets between August 31st of 2018 and December 31st of 2018. And, many of you have asked why we're talking about such a specific time period and not perhaps 2019. And the reason here is due to transparency agreements that have been made with the OECD, which require this information for this very specific period. So the OECD is very emphatic about intellectual property, as I mentioned before, and they have made this very specific question to cover that base entirely and ensure that they are complying with what has been agreed to. All right, let's move into the third question, and this one has been quite polemic. It's actually gone through some changes since it was first introduced to us back in August. And it really is polemic because of the way that it is framed. In very simple terms, what they're asking is whether the company has generated taxable income in 2019. If so, but the company is not a tax resident of St. Kitts and Nevis and does not have commercial activities in the Federation, the answer to this question will be no. And this applies even if the company generated taxable income. The answer is no, because the company is not a tax resident in Nevis. And this is very, very important. Let's move into the fourth question. The rationale of question 4 is to determine if the company is a part of a multinational enterprise group, which generates annual income of over 750 million euros, or the equivalent in Eastern Caribbean dollars. And if so, whether it's required to make country by country reporting. This question was a little bit more complex in the first iterations we got of the form, and it required additional details and additional schedules, but it has since been simplified. So this is good news as well, and it's been simplified to what you can see today. So that's something important to point out in terms of the changes. Okay, so depending on the answers to each question, you will be directed to different schedules which must be completed. That said, there will be many cases where no schedules need to be filled out. So filling out the form does not necessarily imply that you have to fill additional schedules. This will depend on the decision tree and your responses to some of those key questions. Okay, so the key pages in this form are pages 1 and 2. The form itself seems a lot more complex than it actually is, but it's important, again, to note that only some schedules will be required and only under some scenarios. So not all the schedules apply for basic cases.
Thank you, Karina. Hello, everyone. What do you think if we just make a quick stop and have a poll?
Okay.
A question. So go. Do you see it now?
No, not yet. Now we do.
Now, there you go.
Okay,
So does having a Nevis corporations, okay, sorry. Does having a Nevis corporation makes me a tax resident in St. Kitts and Nevis? Or do you have it's a simple answer, yes or no?
It's a good question, and it leads the way to the next
wait
slide.
and see.
So let's see what the response is.
Yeah, exactly. Let's see. Okay. We have like a few seconds if anyone else wants to. Yeah, there's still people answering. Okay, I'm gonna end here. And let me share the results.
Good, okay.
Can you see it?
Yes, good. So 9% of you think yes, 91% of you think no. That's good as we move into our next.
That's good.
Thank you, Paula.
That's really good. Okay.
Okay.
You're welcome. Go ahead.
Good. So let's then move into the topic of tax residence and taxable presence in the Federation. What I'm hoping to do today is provide some guidance for you as we again have received multiple questions on this past few weeks since the CIT form was first introduced, and as a result, the Controller and the Inland Revenue Department developed a guidance document to try to clarify some of the doubts. So there are two parts to this guide. One refers to residence tax and the other refers to commercial presence. So we'll take a look at tax residence first. As I mentioned earlier, St. Kitts and Nevis has a worldwide income tax system. And this basically means that companies are considered tax residents of St. Kitts and Nevis. So those companies that are considered tax residents in St. Kitts and Nevis are subject to taxes based on income generated globally. That said, companies that are not considered tax residents of St. Kitts and Nevis are subject to taxes only on the income that is generated within the jurisdiction. Now, it's important to note that in the absence of legislative definitions, the term resident is interpreted as per its equivalent in common law. So an entity shall be considered a tax resident in the jurisdiction in which the entity is directed and controlled. And in the next slide, we'll talk a little bit about, or in this slide, we'll talk a little bit about the principles of management and control, because this is a most important point to stress out in determining the tax residence of the company. So the tax residence of the company will be considered to be the place where the meetings of the board of directors are held. If the company is managed and controlled outside of the federation, then it will not be considered a tax resident in St. Kitts and Nevis. It's important to be able to demonstrate that in effect, the company is being managed and controlled outside the jurisdiction. So this means that the directors must hold board meetings, minutes should be prepared, and they should clearly indicate that these meetings are the means by which the strategic decisions of the company are carried out. In this sense, directors must be qualified depending on the activities of the company and should be able to make key decisions regarding the company. So here, you'll see that proper corporate governance is really the key. Okay, so moving into the next slide, in summary, these are some key pointers to remember. There is a misconception regarding tax residence and place of incorporation. So tax residence is not determined by the place of incorporation. This is very important. This is something very important to remember. It's important that we clarify this. Companies incorporated outside of St. Kitts and Nevis can be considered tax residents in St. Kitts and Nevis if the management and control is within St. Kitts and Nevis. And companies incorporated in St. Kitts and Nevis can be considered a tax resident somewhere else. So outside St. Kitts and Nevis. All right, so now that we've cleared that up, let's talk about tax treaties, because this is something that is also very important when considering Nevis overall as a jurisdiction. As you may know, a company is not or should not be expected to pay taxes in more than one jurisdiction. And this is where tax treaties between countries to avoid double taxation come into place. Double taxation treaties are also helpful in clarifying where a company should pay taxes in cases where it's not absolutely clear. And more than likely, the criteria will be that taxes are paid, again, where the management and control of the company lies. So by analyzing case by case, a tax expert can determine in which of the two countries the company should be considered a tax resident. This process can take place through a tiebreaker test, in which most cases similar to that carried out to establish the central management and control. The entity, or commonly known as a place of management or effective place of management, is key in determining where the taxes should be paid. St. Kitts and Nevis has treaties, many treaties, including double taxation treaties with Canada, Denmark, Monaco, Norway, Sweden, Switzerland, the United Kingdom, to a lesser extent also with the United States, but it also has treaties with the United States. So this is an important benefit of St. Kitts and Nevis when you're comparing multiple jurisdictions. All right, so let's move now into the second point that I mentioned when we began walking you through the guidance. The first point being the tax residence of the entity. The second important key factor to consider is the commercial presence or the commercial establishment. Basically, a non-resident company will have a taxable presence in the federation if it has a business enterprise in the federation, conducted or has conducted commercial activities for profit. So to meet the business enterprise criteria, the company must have physical presence or physical business operation in St. Kitts and Nevis. The company will then be taxed under the St. Kitts and Nevis Income Tax Act and must file tax returns, pay taxes at the current tax rate, and this will be proportional to the profits of the company that are attributable to the income related to operations carried in St. Kitts and Nevis. All right, so how do we determine whether a company is conducting business and generating income within the federation? So the first thing we need to do is evaluate whether the company has an office. Does a company have a branch? Does it have a headquarter, a workplace? Does it have a factory, a plant, or any kind of workshop, assembly workshops? Is there a construction project or a commercial real estate development underway? Do you have agencies or premises for the purchase or sale of goods within St. Kitts and Nevis? Does the company have a representative in St. Kitts and Nevis? If the answer to any of these questions is yes, then the company will be considered as having commercial activities within St. Kitts and Nevis and will be subject to taxes for the income generated from these activities. And I think we're going to have another poll, Paula?
Yes. Yes, we have another quick question here. There we go. Can you see it now?
Yes.
Okay. If a Nevis entity owns real estate in Nevis, it is deemed to be tax resident in St. Kitts and Nevis, and this is like, let's see what people say because it's very confusing if you think about it. And I think we're gonna see the same thing in the result because they're very.
Yeah. Let's see.
Let's give a few seconds and see how the attendees answer the question. We have a lot of people participating today. Thank you for joining us. Okay, I'm gonna end the poll and share the results. Here you go.
Huh. Interesting. So it's almost split half and half. 59% of you think that yes, if the entity owns real estate in Nevis, it seems to be a tax resident. And 41% of you think that no. It's interesting. So should we share the answer?
Yes, please.
Okay, so the right answer is no. Having real estate or property in St. Kitts and Nevis does not make you a tax resident in St. Kitts and Nevis. Earlier, when we asked the question about whether the company had real estate, employees, generated income, we were referring to the entire business operation, not only owning real estate. So owning real estate does not necessarily imply that you're a tax resident in St. Kitts and Nevis.
Correct.
Okay, so let's summarize the tax residency issue. Key points to keep in mind. If the central management and control is in St. Kitts and Nevis and the board of directors is in St. Kitts and Nevis, the company will be considered a tax resident in St. Kitts and Nevis and will be subject to taxes on its worldwide income. If the central management and control is outside St. Kitts and Nevis, the company will not be deemed a tax resident in St. Kitts and Nevis. And having a St. Kitts and Nevis registered agent does not mean that the company is a tax resident in St. Kitts and Nevis. Okay, so let's recap on the business enterprise part of the guidance. If the company is carrying out commercial activities in St. Kitts and Nevis, the company will be subject to taxes in St. Kitts and Nevis at the current tax rate on its earnings directly linked to its operations in the Federation. Subject to discounts, exceptions, and exclusions provided in the Income Tax Act, but the taxes will need to be paid accordingly. I think we're coming
Yes.
on our last poll of the day.
Last poll of today, yes, and it's more like an informative question. We want to know what our clients think about this or why they did. Why did you choose Nevis to incorporate your entity? And you have a lot of options here: pricing, confidentiality, tax regime, reputation, business-friendly jurisdictions. So let's see what people say. Give them a few
Business-friendly jurisdiction is basically the ease of doing business in Nevis, right?
Yes, usually. Yeah. We have
Okay.
people participating, so let's give them a couple of seconds and see what they say. Okay. Let's share. Here we go.
The tax regime.
Tax regime, yes. We have a business-friendly jurisdiction with a 26%, and confidentiality, of course, is always important, and pricing, not that much.
Yeah.
Reputation.
It's interesting to know the differences in the answers depending on the geography of the participants.
Yeah, we have to see
Different
that. We
from
can
the
look
one
into
that-
that.
Yes, the answers are a little different based on the geographic.
Depending where the client is based on. Yes, of course. Okay.
Well, thanks again. Yeah, thanks for sharing with us. It's interesting. It's interesting to see what the majority of you chose when thinking about Nevis as a jurisdiction. And, you know, we've talked a lot about the recent changes in its tax regime, which I know that is important to most of you participating today. And you know, this actually paves the way for the last poll, the last slide that we have today. After all of this, why Nevis? So with all of these changes, what keeps making Nevis a great jurisdiction? And you know, what are some of the key benefits of having an NBC or an LLC in Nevis? And you know, for one, confidentiality. There are no public registries to date for directors, shareholders, ultimate beneficial owners, even though, of course, the information must be provided to us as registered agents. This information is not by any means public, so it's important to note that. There are no economic substance requirements, and for those of you who have had experience with jurisdictions that are currently enacting economic substance requirements, it's cumbersome and it's a little bit complicated. So it's good that Nevis does not have these economic substance requirements up to date. It's not blacklisted, it's not gray listed by the OECD. Again, largely due in part because of the changes that they've made this year. And companies do not pay taxes if they are not tax residents in St. Kitts and Nevis. So this addresses one of your key concerns in terms of the tax regime. This continues to be a great advantage. Yes, of course, filling out the CIT form can be a bit confusing, and it's an additional step that is now required. But it's important to know that companies do not pay taxes if they are not tax residents in St. Kitts and Nevis. So I hope this has provided a good guide into some of these changes and on how to fill out the form. With this, we can move into the Q&A part of the session. We're here to help in every step of the way. So thanks again for participating, and hopefully we can now move into answering some of the questions that you've sent us throughout the presentation.
Thank you, Karina. It is good that we have still like a few minutes because we have a lot of questions. So let's try to answer all of them.
Okay.
We go with the first one. If a company was dissolved or struck off before 2019 ended, does it have to submit the CIT 101 return? That's a very, very, very common question.
So yes.
What do you think?
Yes. The quick and short answer is yes. Because remember that the period to be reported on December 31st of this year is from January 1st, 2019 to December 31st, 2019. So even if the company was active only partially during this period, it still needs to report. And we do know that this will be a yearly requirement. So the same would apply next year for companies that were only active for a short period of time within 2020.
Perfect. Yes, that's right. We have another question here regarding the interest. Are interest gained from a bank account or an investment portfolio account considered assessable income?
Okay, so yes, the guidelines very clearly state that dividends, interest or discounts, pensions, charge, annuities, rents, royalties, premiums, and any other profits arising from property or annual gains, or profits not falling under any of the foregoing heads will form part of assessable income. So yes.
Okay, thank you. Okay, let's see. We have another here. If an entity owns, well, this is one of, we already answered this, but let's read it. If an entity owns a real estate in St. Kitts and Nevis, it is deemed to be tax resident in St. Kitts and Nevis? We already know that.
I think we covered this one live as well,
Yes.
but let's make sure that this is super clear. So no, tax residency is not determined by owning real estate within the Federation. If there is no mind nor management in the Federation, the entity would not be deemed a tax resident in Nevis.
Okay. Yeah, we already covered that earlier, but it's good to
make very important to stress it out. Yep.
Mm-hmm. This is a really good question. I like this one because I think it makes, I don't know, it makes it easier for everyone. Let's read it. If an entity is not paying taxes anywhere in the world due to the nature of its purpose, for example, a company that only acts as a holding company, a company that only owns a real estate, a company that owns a bank account, in these cases, what should the company answer in the section of tax residency?
Indeed, it's it's a good question and one that comes up very frequently. You know, and according to the OECD guidelines, companies are to be paying taxes somewhere. That said, the option of no country is applicable to those entities that are not tax residents in any particular jurisdiction. So there is an option for those cases where the company is not a tax resident, tax resident anywhere. And that option wasn't available a few weeks ago. So that's a new option that the clients have for their clients. Exactly.
Okay. Let's see if we have another question. Yes, we have a lot of other questions. Let's see. We're good with time. Okay. If the shareholder of a Nevis entity is a natural person and that natural person is paying taxes in another jurisdiction, can it be reported in the CIT 101 return that country as the tax resident of the Nevis entity? That's also a question that I receive a lot from the clients.
Yeah. Here it's important to take a look at the entity. So the answer is no. If the shareholder is paying taxes in another jurisdiction, then the shareholder is considered a tax resident there, but not the Nevis entity. So no, the answer is.
Yeah, it is important to understand there are two different persons. There's the
Absolutely.
company and the owner of the company.
Shareholders, correct.
Okay. So let's see. I have another here. Is it required to provide evidence of the tax payments?
Well, no, not to date. So right now they're asking for a yes or no answer. So there is no evidence required at this time. This may change. And if it does, we'll let you know. But for now, it's not required. It's not a requirement to provide evidence of that tax payment elsewhere.
Yeah, that's right. Okay, let's see. And this is a good question because this is actually something new as well. Can entities submit the form in the IRD portal themselves?
Yes. So this is one of the key changes from when we first received the forms back in August. So yeah, this companies can now go into the portal. They can go directly into the registered entities tab, which was recently added. And again, we can continue doing it for clients that prefer that, but this was one of the key changes from August to now. So you can definitely go and submit your information directly in the portal.
Perfect. You can submit the information, but we cannot upload. And this is the next question. Can the company upload in the portal?
No, I wish we could, but no. The information that is received by us needs to be entered manually. So no, there are no options for submitting in batches or in any other way. It's on a one-by-one basis. That form cannot be uploaded in the system. It's manually entered.
We wish.
Yes.
Okay, now we're changing a little bit the subject, and they are asking if are there any withholding taxes?
Okay, so yes, after the 2018 amendments, St. Kitts Companies Incorporated under the Companies Act and the NBCs and also the LLCs are required to pay withholding taxes. But it's important to note that this will only be applicable if the company is a tax resident in St. Kitts and Nevis or has a business presence or a business establishment in St. Kitts and Nevis. If not, then no.
Okay, thank you. I have a few people asking if we're gonna send the recording of the webinar, and yes, we will. Don't worry, probably a few days from now, a couple of days, we will be sending.
To try to keep the dates. To try to keep.
Yes.
A lot of dates.
Okay. Okay. Oh, this is a good one. Let's see. Will the information of the CIT 101 return be shared for FATCA and CRS purposes, or a country with whom St. Kitts and Nevis has signed tax information exchange agreement? Okay. Will there be automatic exchange of information with the country where the company reports to be tax resident? I'm sorry about this question.
So it's a multiple part question.
Yes, I know.
Okay, so let me start with the first part. So the information to be shared is to satisfy our enhanced transparency requirements as outlined by the BEPS Action 5 2015 report that I mentioned earlier. The requirements for FATCA and CRS are governed by separate laws and separate regulations and have no bearing on Action 5. So the jurisdiction under BEPS Action 5 Enhanced Transparency Guidelines is obligated to exchange the identity of new entrants to the IP regime in the period of August 31st, 2008 and December 31st of 2008. So once again, very specific to IP activity. And if there were no new taxpayers that benefited from IP income or IP activities and no IP assets from existing taxpayers during this 4-month period, then no spontaneous exchanges will occur. So no exchanges will be conducted. So this only applies for IP and only for those 4 months.
Okay, thank you. We still have another question. This is a long one as well. Say, what are the tax consequences for companies that are used as holding companies and do not have activity, assets, or management in Nevis? What are the filing requirements for these companies who must file the return? We have 3 questions here, actually.
Okay. Okay, so what are the tax consequences? So these companies in theory are not required to pay taxes. The CIT forms must be filled by all companies, regardless of whether the company is a holding company or not. And I think the third question was, who must file the returns? So that again can be answered by one of the key changes to the new forms. So either the registered agent or the entity itself can make the filing directly in the St. Kitts and Nevis portal.
Okay.
Option that's available to everyone.
Okay. I have another question, and it says, if I don't have activities in Nevis, where should I put the head office? Well, the head office is always where the company is having
control,
management and control. So it should be the address where probably the directors are located, or where the meetings are done. So
that is correct.
Okay, let's see if we have probably time for one more question. We have an interesting question here, and they're asking if we expect to have another amendment before to the form before the deadline. I don't think we can answer that.
That's a tough one to answer because we didn't think that we would receive a different form. We did know that the time that we were given initially in August, I mean, we were given 2 weeks to fill out this form. So it was pretty unrealistic, an unrealistic time frame to fill out the form. So we were expecting an extension. We're happy that we have an extension now to December. And we have this new form. I do not expect changes to the form itself. It's really important to note as well that if you did fill out the form prior to the new form, this is not a problem at all. We can submit the information with what we had prior to October 31st. So the forms are perfectly valid. If I had to answer, I would say we're not expecting changes to the form, but it's not
something that we can guarantee.
No, We cannot guarantee it, and if there are changes, we'll let you know as soon as possible. And I would think that the same rationale would apply. If you've already filled the form, then this is for next year and for other years moving forward, but you don't have to go back and refill out a form.
Well, thank you, Karina. I think we are in time.
Okay.
We do have a lot of more questions, but I don't want to extend this anymore.
Okay.
So maybe we can just answer them
Via email, of course.
Go ahead, sorry.
No, definitely. We can answer them via email. And if there are any other questions afterwards that you can think of, we'll be happy to answer those as well. It's really important to note that we're here to help. If you need help filling out the form, or if you have any further questions, please reach out to us and we'll be happy to help you evaluate all the options.
Yes, please. So thank you very much for joining us and have a good day, everyone.
Wonderful. Thank you.